Up front, we talk about the government, which is gearing up for its FY26 borrowing spree. For the first half of the fiscal, the centre is set to raise 8 lakh crore rupees, and this they will do through 26 weekly auctions. And these auctions are strategically spread across tenures. There's a mix of buybacks and security switches. And of course, the ever-flexible green shoe option is also in play. But let's bring in my colleague Prakash Priyadarshi. He's joining us from Delhi to walk us through the plan. Prakash, do tell us, how is the centre now planning to borrow in the first half of the new fiscal FY26?
Yes, the government has announced the borrowing plan for FY26, which is approx 8 lakh crore during first half of the next financial year. Approx 54% of the budgeted amount, which is at 14.82 lakh crore for FY26. So that's an important development coming in from the market standpoint, where the government has said that the borrowing will be done through debtor securities, where 10,000 crore will be borrowed by issuance of short and green bonds. Along with that, the gross market borrowing of rupees 8 lakh crore shall be completed through 26 weekly auctions, where the government will continue to reserve the right to exercise green shoe options to retain an additional subscription up to rupees 2,000 crore. Along with that, when it comes to weekly borrowing through issuance of treasury bills, that will be approx rupees 19,000 crore for 13 weeks. In addition to that, the government has fixed the ways and mean advances limit for H1 of FY26 at rupees 1.5 lakh crore. And the government has made it very clear that it will have the flexibility to modify the notified amount and timing for auctions depending upon the requirement of the government and market conditions. Back to you.
That is the plan, and thanks for walking us through what exactly has been put down by the government for the first half of FY26, and we're looking at more than 50% of the target that was set in the budget as far as borrowing goes. But now, with that plan comes the real question: how does this borrowing plan align with the broader fiscal goals? Will global uncertainties like these tariff wars, the interest rate pivots, also the geopolitical tensions, will they throw a wrench in the works? To help us make sense of it, we are joined by Gaura Gupta. She is Chief Economist at IDFC First Bank, and along with her, we have Siddhartha Sanyal, the Chief Economist and Head of Research at Bandhan Bank. Good evening, both. Welcome to India Tonight on ET Now. Gaura, first to you. This borrowing calendar, it's crucial for both market participants as well as policy watchers. But given the government's fiscal stance, how do you see this shaping liquidity and yields in the first half of FY26 at least?
So the calendar was less front-loaded than expected. Usually the borrowing program, we had expected this year, instead of 54% first half issuance of the full year, it would be more normalized to the usual pattern where the center, let's say, borrows around 58% of its full year in the first half, or to 60% of the full year in the first half. This year, the expectation was that the calendar would be a little more front-loaded, because last year, when they had 53% of the full year borrowing in the first half, the more, I would say, equal distribution last year was because there was the JP Morgan bond index inclusion, which took place mainly in the second half of last year. This year, we don't have a bond index inclusion, at least not as yet. So it's a little lower than expectation in terms of the first half front loading. So definitely in the near term, in terms of supply, it translates into around 5.9 trillion of net supply in the first half, which is slightly or similar or slightly higher than last year, but similar levels. And given the fact that RBI is has already done significant OMO purchases in FY25, and we expect them to continue conducting OMO purchases in FY26, we expect that it will be good for the GSEC market. We expect 10-year yields to come off to around 6.4 to 6.5, supported by liquidity infusion via OMO purchases in FY26. Also, the rate cut cycle, we expect another 50 basis point cut in the remainder of the year from the RBI. So both of these factors will support rally in the yields. The other part of the borrowing program, which was good, which RBI clearly took market feedback back. The program was less concentrated in the ultra long bond, basically the 30-year to the 50-year, because insurance companies which tend to absorb or buy the ultra long bonds, there has been a slowdown in business momentum. So the appetite for ultra long bonds this year is expected to be lesser than what we saw last year.
Yes.
The government plus RBI clearly took that into account. They've reduced the concentration. The ultra long bond segment is 35% of the first half,
Yes,
compared to 37%. They've increased the allocation in the shorter end of the curve, which is
yes,
again beneficial because we will have better liquidity
yes.
in FY26.
Let me ask Siddhartha if he agrees. Siddhartha, this inclusion of the longer tenure securities up to 50 years, what does it signal? Is it a shift in debt management strategy, or is it just about catering to institutional demand?
Very, very valid question, Vikram, and I think Gaurav articulated very nicely. Very clearly, what was happening in the last few years, insurance companies, pension fund, provident funds, they were becoming more prominent in the Indian system, and their presence was increasing very clearly. But as compared to some of the previous years, right now, there is some softening in long-term interest rates, as well as a lot of extra pumping in of near-term liquidity at this moment. So at this moment, thus, it's not a surprise that there's a lot of borrowing in the near-term segment rather than the long-term segment. I think that gels well with market's expectation. Also, in terms of what proportion of overall full year government borrowing has been earmarked for H1, it's broadly in a range which will not be too surprising. There can be debate at the margin whether it could have been a little lower, but I think broadly it will not take the market by any surprise. So I think overall it's a happy situation.
Happy situation.
Liquidity is coming in.
Yes.
There is more expectation of rate cut going ahead.
Yes.
RBI is doing a bit of OMO on a constant basis, so that will also offer support to the government bond market.
Yes.
So overall, one can expect some more rally in the government bond yields towards softening.
So more rally in the government bond yields is what you're expecting with this kind of plan. But Gaurav, at the far end, or perhaps even closer, the US imposing fresh tariffs, these trade tensions rising. Tell me if external volatility could impact borrowing costs for India.
No, actually, external volatility can definitely affect the rupee, the INR, because let's say if there's a sort of a risk off. But the issue with the tariff tensions in the US, it's more harmful for the US right now. I think unless, let's say, the US markets start pricing in a sharp pickup in inflation pressures due to the tariffs, then only the equation can change. Right now, I think the fixed income market, I would see more chances of US yields coming off because of a real threat to the growth recovery in the US, because not just of the tariffs, but the fact that there is a change in terms of fiscal expenditure with the DOGE cuts in the US. So that could really undermine the US exceptionalism, and you could see actually further moderation in US bond yields. So I don't see too much of a risk to our markets. Obviously, never say never, but I would see the tariffs posing as a more sort of a near-term volatility to the currency more than to the bond market.
Siddhartha, now what about these oil prices? Because those remain a wild card. If crude spikes significantly, does the borrowing roadmap still hold steady, or could we see revisions mid-year, you think?
So I think you mentioned about the oil prices. I tend to think that there are a couple of them. One is obviously oil prices, and in general, the global geopolitical situation, in case if that impairs the global supply chain, global commodity prices. That is one area which we need to watch continuously. Also, given we are very close to the month of April, possibly next few months, we have to watch very closely what is the expectation panning out or forecast panning out. So far as monsoon in India is concerned, the last 2 months, including March and February, had been slightly more warmer than what it used to be over the last 20-30 years, which is one particular area we need to be quite watchful. But possibly by the end of the next month, we'll have better picture about how the domestic weather conditions are panning out. So these are the two areas which I'd be a lot more watchful about over the next 3 to 6 months.
And Gaurav, I was going to ask you about the government retaining that green shoe option. it means that they can raise additional funds whenever is required. Do you expect frequent usage of that tool, or will it be more of a backup plan, you think?
That's a normal option. They always have the green shoe option. I won't read too much into it, but I think that one more factor which I forgot to mention, which will support the fact that for the demand for the bonds in FY26 is because a lot of OMO purchases that RBI has already done in FY25. So banks will want to load up on bonds. So at least in the near term, so that'll be good for the first half demand because there's been a lot of selling by banks from their HDM books during the OMOs that were conducted in FY25. So that will create a fresh demand in FY26. And also another good factor for demand is going to be the fact that we do expect deposit growth to pick up in FY26 because of all the liquidity infusion, again, which is positive for bank demand for GSECs. So the green shoe option, they are always, RBI is always welcome to use it, but I think that's just a normal option that they always keep.
How much it's used is the question, but Siddhartha, just taking off from what Gaura is saying in terms of demand, weekly treasury bill issuance has been pegged at 19,000 crore rupees. How do you see short-term rates moving in response to this?
Well, I think that's manageable at this moment. Also, there has been an announcement about the ways and means advances, so that will also provide some bit of cushion. And in the near term, it depends a lot on how exactly the liquidity situation is panning out. At this moment, we have seen very clearly that the RBI is very, very committed to provide the liquidity that is needed for the banking system. I don't think there will be a quick change in stance on the part of RBI. Having said that, till the months of January or February, there had been a lot of market intervention that was needed on the FX market, and as a result, the liquidity infusion from the domestic route was not fully effective. But if we think that there is some kind of a near-term reversal in the dollar index at this moment, and we might not be needing as much as FX market intervention, the liquidity support on the part of, which the RBI is providing at this moment can actually be more effective. So I think the near-term rate should get some support from these factors.
We've seen an uptick in corporate bond issuances. Do you think the government borrowing at this scale could possibly crowd out private sector debt?
Is that a question for me?
No, I was asking Siddhartha. Siddhartha, would you like to take that on first?
Sure. Could you repeat, Vikram?
Yes, absolutely. I was saying that this uptick that we are seeing in corporate bond issuances, do you think that this kind of government borrowing plan could crowd out private sector debt?
No, I'll not worry too much on that particular aspect. It's not too unexpected. There is a bit of an expectation that was building up that there will be some activity on the part of the private entities also going ahead. So I don't think the numbers are that big. That will be derailing the overall situation in the bond market or in the money market at this moment. Again, as I said earlier, there could have been discussions whether the borrowing could have been marginally lower, but only marginally. And given that there is a bit of stability on the currency front from the external side, constant support from RBI on the liquidity side, I tend to feel that overall, the situation will be pretty decent for the fixed income space going ahead in the very near term.
Well, India's had this healthy share of foreign investor participation in the bond market, and now with rate cut expectations that are shifting globally, we'll have to wait and see if the foreign appetite is going to rise again for Indian bonds. But it's clear that the government's borrowing strategy for FY26 is a balancing act. We are managing liquidity, ensuring fiscal prudence, navigating global headwinds as well. But of course, there is the green shoe option, long tenure securities, the weekly treasury issuances. Every move is going to be closely watched by the markets and policy makers. But a big thank you to my panelists, Gaura Gupta, Siddhartha Sanyal. Thank you for breaking it all down for us. This conversation, of course, far from over. We'll be tracking every twist and turn. But we'll take a very quick breather. On the other side, we turn our attention to the Times Now Summit. Piyush Goyal, the Union Minister, speaking over there. We'll be back with it in a jiffy. Do stay with us.